Have you noticed lately that your paycheck doesn't stretch as far as it used to? That the same $50 grocery run barely fills half a cart? Or that rent, gas, and even your favorite streaming service all seem to be getting more expensive? You're not imagining things. Your money is buying less, but why? Where does all that extra money go anyway? In this video, we're unpacking the hidden cost of inflation. We'll explore how rising prices quietly erode your purchasing power and what you can do to protect yourself. What inflation is. Inflation. It's a word we hear a lot, especially when prices are climbing. But what does it really mean? Inflation is the rate at which the prices of goods and services increase. As prices rise, the purchasing power of your money falls. That's inflation in action. For example, 30 years ago, a cup of coffee cost about $1. Today, it might be $3 or $4. The same thing is happening across the board with everything you buy. Groceries, gas, rent, clothes. It adds up. But why does inflation happen? Let's break it down. There are three main causes of inflation. Causes of inflation. The first is demand pull inflation. This happens when more people want to buy goods and services, but there aren't enough to go around. When demand outpaces supply, prices go up. Think of a hot new product launch. Everyone wants it, but there's limited stock. Sellers can charge more because people are willing to pay more. The second cause is cost push inflation. This happens when it becomes more expensive to make products or provide services. Maybe the price of raw materials goes up, or workers demand higher wages. Companies pass those higher costs onto you, the consumer, by raising prices. The third cause is built-in inflation. This is where things get cyclical. As prices rise, people expect them to keep rising. Workers ask for higher wages to keep up with the cost of living. Companies raise prices to cover those higher wages. And the cycle repeats. Inflation as the silent thief. Here's the tricky part. Inflation is often called a silent thief. It slowly chips away at your purchasing power, and you might not even realize it's happening. If inflation is 5% in a year, your $100 today will only buy you $95 worth of goods next year. That loss adds up over time. At 3% inflation, which is considered moderate, the value of your money could be cut in half over 20 years. That's why inflation is such a big deal. It quietly makes everything more expensive, while your money stays the same. Real-life examples of inflation. Let's look at some real-life examples of how inflation shows up in your everyday life. Housing costs are a major one. If you rent your home, you've probably noticed rents going up. In some cities, rents jumped over 10% in a single year. That means you might be paying hundreds more each month for the same apartment or house. Food prices are another area where inflation hits hard. The cost of basic groceries, milk, eggs, bread, meat, has gone up significantly. Food inflation impacts everyone, but it's especially tough on lower-income households where a bigger percentage of income goes toward food. Gas and energy prices have surged too. Not only does that hurt at the pump, but it also makes everything that relies on transportation more expensive. That includes the cost of shipping goods to stores and heating your home. And inflation doesn't just hit consumers. It affects businesses as well. Small businesses face rising costs for materials, transportation, and wages. They have to decide whether to raise prices, absorb the costs, or cut back on staff. None of those choices are easy. Even big businesses feel the pressure. Airlines are paying more for fuel. They pass those costs on through higher ticket prices. Manufacturers pay more for raw materials and shipping. That cost is passed on to consumers through more expensive products. Historical cases of inflation. To better understand how inflation works, let's take a quick look back at history. The United States experienced severe inflation in the 1970s. After an oil embargo drove up fuel prices, everything else became more expensive too. The economy slowed, unemployment rose, and prices kept climbing. This period was known as stagflation, a combination of stagnation and inflation. Zimbabwe experienced one of the worst cases of hyperinflation in modern history. In the late 2000s, prices doubled every day. At one point, Zimbabwe printed a $100 trillion bill. That bill wasn't enough to buy a loaf of bread. Venezuela faced a similar crisis. Hyperinflation made its currency practically worthless. People weighed stacks of bills instead of counting them. Many turned to bartering because money no longer had any value. These are extreme examples, but they show what happens when inflation spirals out of control. Who wins and who loses from inflation. But here's an interesting twist. Inflation doesn't hurt everyone equally. Some people and institutions actually benefit from inflation. For example, debtors, people who owe money, can benefit. If you have a fixed-rate mortgage and inflation rises, you're repaying your loan with money that's worth less than when you borrowed it. In real terms, your debt becomes cheaper. Governments can also benefit. Inflation can reduce the real value of government debt. As prices rise, tax revenues usually increase because people are earning and spending more. That extra revenue can make it easier for governments to manage their debts. On the other hand, some groups suffer more than others. People on fixed incomes, like retirees who rely on pensions, are hit hard. Their income stays the same while the cost of living rises. Over time, their money buys less and less. Savers also lose out. If you keep your money in a savings account earning 1% interest, but inflation is 5%, you're losing purchasing power every year. Your money is growing slowly, but prices are rising faster. How inflation is measured. So, how do we measure inflation? One of the most common tools is the Consumer Price Index, or CPI. It tracks the average price change over time of a basket of goods and services, including food, housing, transportation, and healthcare. There's also core inflation. This measure excludes food and energy prices, which can be volatile. It gives a better sense of the underlying trend. Another measure is the Personal Consumption Expenditures Index, or PCE. The Federal Reserve watches this measure closely because it accounts for changes in consumer behavior, like switching to cheaper alternatives when prices rise. What causes inflation to spike? Now, let's explore what causes inflation to suddenly spike. Supply chain disruptions are a big factor. During the COVID-19 pandemic, factories shut down, shipping slowed, and goods became scarce. As demand recovered, supply couldn't keep up. Prices soared. Energy shocks also contribute. When oil prices spike, transportation and manufacturing costs rise. That leads to higher prices across many industries. Loose monetary policy can play a role. When central banks keep interest rates low and governments spend more, it can increase the money supply. If too much money chases too few goods, inflation rises. How you can protect yourself from inflation. So what can you do to protect yourself from inflation? One strategy is to invest in assets that tend to outpace inflation. Stocks, real estate, and commodities like gold often perform better than cash during inflationary periods. Treasury inflation-protected securities, or TIPS, are government bonds that rise with inflation. They offer a way to protect your investment from losing value. Diversifying your income streams can help too. Side hustles, freelance work, or dividend-paying investments can supplement your main income and offset rising costs. Keeping your skills up to date is also important. Inflation can lead to wage stagnation in some industries. Staying competitive makes you more valuable in the job market, increasing your chances of getting raises that keep up with inflation. How governments respond to inflation. Governments and central banks have tools to fight inflation. Raising interest rates makes borrowing more expensive. That cools spending and slows the economy, which can bring inflation down. Central banks can also tighten the money supply by reducing asset purchases or increasing reserve requirements for banks. These moves can help control inflation, but they can also slow economic growth and lead to higher unemployment. It's a delicate balancing act. Inflation today and what lies ahead. Inflation isn't just a problem of the past. After the pandemic, many countries experienced a surge in inflation. Disrupted supply chains, energy price shocks, and labor shortages all contributed. By 2024, inflation rates had begun to ease in some regions, but uncertainty remains. Geopolitical conflicts, energy volatility, and climate-related disruptions can all trigger new inflationary pressures. Conclusion and final takeaway. So, what's the bottom line? Inflation is a fact of life. It's not going away anytime soon. But understanding how it works and how to protect yourself can make a big difference. Be proactive, stay informed, make smart financial choices, and you can navigate the challenges inflation brings. Thanks for listening. If this explanation helped you understand the hidden cost of inflation, consider sharing it with a friend. Stay informed, stay prepared.